the banking institutions was to, in a way, help the financial systems to address relevant and material risks that would impact a financial institution. So the reason why then different jurisdictions, especially across sub-Saharan Africa, not only within Africa and also parts of Asia, was to enhance their supervisory systems, and also to ensure that their supervisory systems are able to address risks that ideally would materialize within that particular financial system. So that led to the need to have this particular framework that would ensure that people who are benefiting from these insurance companies, be it policyholders or their beneficiaries, are able to deal with companies that will be a going concern and will be there to provide to them in case they are facing a particular risk. So this led to financial institutions really looking at what are these particular sources of risk. And then there are different risks that we've managed to look at. For instance, what we call the claim reserve risk. And this risk basically arises out of the valuation, or basically the liabilities that the insurance company has put in their books might not be able to meet all the liabilities because of the uncertainty whereby a claim, one claim might be big, and they might need to basically dig into their capital resources. There's also need to look at issues around the premium. Some premiums might not be adequate, or they might not be in a position to meet all the policyholder obligations. So there's need to have some capital that will deal with issues around premiums. There are catastrophes that might arise, and currently we are talking about a very big pandemic that is affecting the entire world. These might have an impact, and there's need to have some money that will take care of these particular catastrophes that might impact the balance sheet. There's credit whereby your counterparties might not be able to pay you, and they are defaulting. So you might need some money to take care of that particular risk of default. There is issues around market prices movements. If the stock market crashes, or there's a loss of value within the stock market, you might need money to take care of those particular exposures. Then there's also things such as the operational risk. How then does a company manage their operations in terms of dealing with claims, in terms of dealing with credit management strategies, investment strategies, risks that might arise out of people and systems. There's need to take care of those particular risks when it comes to capital adequacy. So all these are things that needs to be considered, and they'll be considered in different buckets in terms of how these risks categories depending on each other. So we are going to look at risk dependencies. How do we recognize these particular risks in the balance sheet? How then do we ensure that these particular risks are mitigated? And also looking at some of the risks that are not highly quantifiable, such as strategic reputational risks. How then do we deal with these particular risks? And these risks will be highly dealt with in terms of Pillar 2 when it comes to alignment of business. So we were having different questions. And even before I go to the tool that I want to show, and this will give us an understanding of the balance sheet of a company and how these particular risks are picked from that particular balance sheet, and provide us with a clearer view of why then are we talking about this particular solvency framework? We need to understand that the purpose of capital is to ensure that the business is a going concern and the business can take care of those unexpected exposures. Most of the time, these are the things that will make a company go bust. There are different approaches that can be used, and I've discussed this earlier. We have a risk factor approach whereby each and every risk is there's a particular value that has been given to that particular risk, to more robust methods such as stochastic method that will require some form of stress and scenario testing. We've talked about 5 primary risk charges that are highly captured in the capital models. We talk about insurance risk, which can be divided into claim risk and premium risk. We have credit risk, we have market risk, we have operational risk, and some other jurisdictions have gone ahead and computed capital that is related to concentration risk. Now, I want to go into a tool that I should be able to share with all of us that will kind of give us an idea of what I'm talking about. So we've been working on a tool that we are calling the Safari, a Simplified Solvency Framework that we are basically spearheading in 7 countries: Eritrea, Ethiopia, Kenya, Malawi, Rwanda, Tanzania, and Uganda. And this looks at having a proportionate approach for insurance supervisors to increase supervision and regulation within the region. So this tool is a fit for purpose. It looks at the first pillar, the risk-based capital adequacy framework. It looks at the second pillar, which is enhanced risk-based supervision, and the third pillar, which basically looks into market disclosure. So it is very easy to apply a tool whereby you select a number of risk charges. It's driven through an Excel worksheet. And the first thing is that a company will look at their balance sheet. And if you look at an institution balance sheet, it has assets and liabilities. So you look at issues such as investments, property and equipment, to issues to deal with loans, to receivables, and then looking at the other side of the balance sheet, the liabilities. So once a company has this particular balance sheet, the thing is that the difference between assets and liabilities will be equity, and this will provide its financial strength. But one of the things that you should be able to recognize is that the financial strength of an institution will be highly impacted by the movement of assets and liabilities. So if assets lose value, then it means that the company might be at a position not to meet all its obligations, which are the liabilities. So there is need to have what we call a factor approach, whereby for each and every item within the balance sheet, you have to look at what risk does this particular item represent into the balance sheet. So for instance, we have market risk, we have credit risk, we have insurance risk, then we have concentration risk. So all these risks need to be computed, and these risks will be picked from the balance sheet of a financial institution. So for instance, if a company only has an owner-occupied property, and that property is worth, say, $500,000, the company will require to have a capital of around 20% of that. 20% of 500 will be around $100,000. So that is the amount of capital that a company will be required to have. So out of each and every item within the balance sheet, we are going to compute an equivalent capital. And the company should be able to put that amount aside to take care of that movement within those particular items within their balance sheet. The same thing applies to the credit risk, whereby there's a charge, and that will give a commensurate amount of capital requirement. Over and above that, then there's what we call the capital that will be required. So within the market risk, you'll be able to see there are different aspects of risk. There's property risk, there's equity risk, there's interest rate risk. And all that will give an equivalent amount of money that will be required to take care of market risk. Credit risk will be computed. We ideally discussed two risks under insurance risk, the claim reserve risk and the premium risk. That will give rise to the insurance risk and all that. The company will also look at what they have within their books, because one side is what they are required to have, another side is what they have. We are going to compare what they are required to have and what they have. Now, we also look into the pillar 2. What are these other risks that need to be addressed by the insurance business? So again, I'll be able to share with you some of all these tools, whereby you can basically play with the numbers and look at how they do change. So you'll need to do what we call a risk assessment on your own business aspects, on different elements of risk. That will lead to what we call the capital adequacy, whereby now we are going to look at what the company has within the tiering system. We'll have tier 1, tier 2 capital, what has been deducted, and what the company is required to have. Over and above that, we'll know what element or level of capital adequacy the company has. Most of the time, we don't want a company going below this red line. A company should always operate above the green line, but also some companies will be between the red and the green line. Ideally, most companies are required to be above the green line. Over and above that, the company will have what we call more of like a heat map based on where they are. So as the capital adequacy changes, so for instance, if I change that 3, you'll realize that this capital adequacy moves from where it was 1, it was on the green. If that changes over time, so I say it was a 4, then the capital adequacy changes. So ideally, this tool enables a company to do the assessment on capital. It enables it to enhance its RBS, risk management process, whereby it will be doing its own risk assessment. And over and above that, it kind of gives where the risk is moving over time, which is quite important when it comes to RBS process. Now, one of the things that we've realized within different frameworks is that they don't provide a stress testing component. So within the tool, within the Solvency II, Simplified Solvency II framework, we are going to look at how then a company or a jurisdiction will be able to enhance their stress testing framework. So we'll be able to get different shocks applied to different elements within within the balance sheet items, and over and above that, you'll be able to see the shocks and how those shocks will be able to impact your risk assessment process. Now, what are the issues that we need to work out within this particular discussion? One is that within the insurance balance sheet, each and every item within the balance sheet is exposed to different types of risks. And what we need to do, we need to ensure that the institution or the financial institution is at a place whereby they are able to mitigate and ensure that they are able to control those particular risks. In case where they need extra capital, they must be able to get that capital within their capital resources. And that basically gives us, takes us to where the discussion whereby we are saying that the capital required and the capital available, what the company has, must always be greater than what the company is required to have. In case this amount was more than what we have at this level, then it means that the company is exposed and the policyholders will be exposed in a way that this company might not be able to meet their obligations. I want to stop at that because this is just an introduction. The next webinar will now deal with each and every risk in detail, whereby we'll now break within each and every risk and look at how then we determine these particular factors. I'll take it back to you guys and see whether there are questions that you have, such that we should be able to I will be able to answer some of your questions at this point. So you can basically, if you have a question, you can unmute yourself, and then we'll have a discussion. Thank you. If you have a question, you can unmute yourself. There's a place where you can unmute yourself.
Hi, Elias.
Hi.
This is Wanjiru Ng'ethe. I wanted to ask, how do we determine the capital charge, or is it something that is given based on the company policy?
Right.
For each of the balance sheet items.
Okay, great. That's a very good question. Now, when it comes to capital charges, and there's a slide that I kind of skipped intentionally. Let me get into this slide, and this will give us some of the answers that we need out of that question. Now, the capital charges that each and every institution will come up will depend on two things. One, there are those jurisdictions that do compute capital charges and provide them to the entire industry. So for instance, in Kenya, these factors have been computed from the regulator's office. Then they are given as a requirement to all insurance companies that these are the capital charges that you have to apply. Now, these capital charges are computed using two methods. We have what we call a value at risk method and a tail value at risk method. We are going to look at the data in the past and compute what are the tail risks. So for instance, if you look at this particular graph that I have on the lower end of the slide, we are saying that we want to compute a charge for our reserves. For this case, we talk about the claim reserves. So what we expect is that the claim reserve will be on the expected. So assume that you are doing a particular class of business. You expect in each and every year, you are going to pay claims for 10 motor vehicles. So what happens if there are more than 10 motor vehicles? You might need to get some extra money, and that should come out of your capital. So most of the time, you look at the extreme values. What happens in case we have 12 vehicles getting an accident? So I'll need capital for extra 2 vehicles to take care of that particular risk. So in that particular case, companies can develop their own factors because when you look at the industry factors will be based on all the companies within the industry, but specific companies can have their own experience and know what will be our capital charges or our capital factors. So this ideally arises out of two methods: value at risk method or tail value at risk method. These are things that I will be able to illustrate on our next webinars, whereby we'll practically go into how then these items are basically computed. Again, it's issues about risk tolerance. You are looking at an exposure that will happen once in 200 years, or is it an exposure that will happen once in 100 years or once in 50 years? That is something that you need to decide. And most of the time we take this to be a 1 year time horizon. So in some jurisdiction in Europe, companies do determine their own factors, and that is usually the internal model factor. Some jurisdiction do it's provided by the entire industry. It's formulaic and it's given by the regulator. Right. Any other question?
Thank you.
Again, you can unmute yourself if you want to ask a question. Or if you are unable to unmute, you can raise your hand. I'll be able to help you unmute. Maybe I can give a chance to Renata. I see Renata is online. Renata, kindly, maybe you have some comments that you would like to make. Maybe I can introduce Renata. Renata is one of veteran actuaries in the world. She's been working in very many jurisdictions in West Africa and the entire Africa. She's from France. Renata, please.
Thank you, Elias. Unfortunately, I only watched the latest, the last 15 minutes of your presentation because, I didn't get the invitation, etc. So I would like to congratulate with your presentation, also with the tool. I wish to know if this presentation will be made available across Africa, if it will be translated into French, because as you know, in Africa, they also speak French. So these are my direct questions. I just want to congratulate with all the work with the tool and, move forward with your, all your ideas and your initiatives for the benefit of the actual profession in Africa. And between brackets, I'm not French, I am Belgian. And actually, I don't speak French, I don't speak English, I speak Dutch. Thank you and have a nice afternoon and good continuation.
All right, thank you, Renata. Thank you, Renata. And thank you for your comments. As you've stated, we'll be still be supporting Africa, and thank you for all the work that you've been doing in Africa, especially in the French jurisdictions. And I hope that from this, we'll be able to also translate this into French. And we'll be looking forward to collaborating with you to ensure that we are able to get this thing going.
Yes, Elias, if we can do something on the French side, I can introduce you to CIMA, I can introduce you to the regulators in North Africa, and really your work would be very beneficial for all those non-English speaking regulators in Africa. Thank you once again.
Thank you. Okay, I'll take it back to the participants. Any question? And maybe from where I sit, something that you would want us to improve going forward in terms of this particular work. And maybe if I'll pick on Bahati. I know Bahati, you are from Tanzania. Just to want to get what is happening in Tanzania, and then maybe if there's something that we can do in that particular front. Bahati Ogola.
Yes, sir. Good afternoon.
Afternoon.
Yes, I didn't join you in time because I was facing some technical challenges here with my laptop. Even now, I'm using two PCs. Yeah, I've seen your presentation and I've seen it is much beneficial to us as in the Office of Regulator, and would like to go much in detail so that we can apply it to our insurance companies. Yeah, the only challenge we have now is that we do not have something that can support it as a regulation or law, but as time goes, we reach there. But at this moment, we'd like to be much aware of the aspects of risk-based capital. For us, in practice, I've seen it sometimes challenging because there are concepts which are new to us. They need to learn much more. But as we'll be sharing the slides with us, I think will be beneficial in gaining much insight into it. Thank you so much.
All right, thank you. I think we are having 5 or so minutes to conclude. Mine is just to reiterate and thank each and every participant for joining this particular call. Our next call will be on InsurTech, driving value for InsurTech, before we again go into more technical discussion. I think it will be important also to look at how then do we support InsurTech and how then do we drive value of InsurTech given the rise of COVID-19 that is basically changing the way we are looking at our business processes. Again, I'm grateful for all of you that having joined this call. I'll be able to share the slides. My email is open. If you have very specific question, you can ask through email. I'll be able to get back to you with appropriate responses. I know we had a team that was joining from Mongolia. I don't know whether, but Raj Gar, you have a question or a comment? We are having 3 minutes. All right. Team from Mongolia was trying to connect, but maybe I can talk to Osama from, if there's comment, 3 minutes remaining.
Hello.
Hello.
Hello. Thank you very much for your presentation. It is very interesting. We are now working to implement risk-based capital solvency framework in Tunisia, and I think that your presentation is very interesting for us, and also the tools is interesting, and we can get many idea from your presentation. Thank you very much.
Thank you. As stated, I'll be able to share the tool and the slides for countries such as Tunisia. Let's see how then it will be able to assist and give you a springboard to as you develop your tool, your solvency standard. Once again, I want to thank all of you for participating in this call. It is always an honor to have a team that is compassionate to transform the financial sector in terms of creating resilience, not only in technical terms, but also in terms of creating that capacity and knowledge that goes in a long way in supporting the financial systems. Once again, thank you very much for joining. Until next time, I should be able to communicate on our next steps. So thank you very much and enjoy the rest of your day, and ensure you stay safe, you stay home. We flatten the curve. Thank you.
Thank you so much.
Thank you.
Thank you.
Thank you.
Thanks, Elias.
Elias.